If you're looking for a reliable way to passively build your wealth in the stock market, then index funds are your answer. Don't take my word for it. Here are a couple of quotes by Warren Buffett. Consistently buy an S&P 500 low-cost index fund. I think it's the thing that makes the most sense practically all of the time. He also said, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. It's no secret that successful investors like Warren Buffett and many self-made millionaires use them as a core part of their investment strategy. So, in this video, I'm going to guide you through the process of investing in index funds. Whether you're new to investing or just looking for a smarter way to grow your money, this strategy can help you achieve your financial goals. What are index funds? These funds first hit the scene back in the 1970s, and they completely shook up the world of investing. Index funds are a type of mutual funds that are all about tracking a specific stock market index. A stock market index is basically a tool used to track the performance of a group of stocks. Think of it as a list of stocks that share certain characteristics, such as being part of a specific industry or having a certain type of market capitalization. This means you get exposure to a ton of different stocks without having to break a sweat. So why are index funds such a big deal? Well, before index funds came along, investors had to rely on mutual funds with high fees and usually mediocre performance. Index funds changed all of that. The main difference between index funds and other types of mutual funds is their investment strategy. Index funds are passively managed, meaning that they simply buy and hold all the stocks in a particular market index, and as a result, they usually have much lower fees and expenses when compared to actively managed mutual funds, saving you lots of money. The S&P 500 is a widely known index that tracks the largest 500 publicly traded companies in the US. If you invest in an index fund that tracks the S&P 500, you'll essentially be buying shares in all 500 companies that make up that index. By doing this, your returns will mirror the gains and the losses of that particular index. The S&P 500 is just one example of a stock market index, but there are many others out there. Some examples of popular indexes include the Dow Jones Industrial Average, the NASDAQ Composite, and the Russell 2000. Each index tracks a different group of stocks, so it's important to choose an index fund that aligns with your investment goals and strategy. Why an index fund? Investing in an index fund offers several benefits that make it a compelling investment option. First, it provides diversification, which helps reduce risk over time. Investing in a single stock puts all your eggs in one basket, and while the returns of individual stocks can be significant, they can also be significant in either direction. Take the Fidelity 500 Index Fund as an example. This fund tracks the companies in the S&P 500, which are essentially the biggest 500 companies in the US, such as Google, Facebook, Disney, Apple, and Microsoft. If you buy a share of this fund, it's as if you're buying a small share in all these companies. And since these funds are designed to be held for the long term, another added benefit is that historically, the market has gone up over time, ignoring short-term fluctuations. As I mentioned in my previous video, the average yearly returns over the last 20 years of the S&P 500 fund is approximately 10%, and it's worth noting that this includes 2 recessions during that time period. Lastly, investing in an index fund is very straightforward, making it a great option for every investor since it doesn't need any special knowledge to get started. Index fund or an ETF, what's the difference? People often use these terms interchangeably, but even though index funds and ETFs are extremely similar, there's one major difference between them that you need to know, and that's how they're traded. ETFs, or exchange-traded funds, also track a specific market index, but they're bought and sold on the stock exchange, just like individual stocks, and their prices fluctuate throughout the day as investors buy and sell shares. Index funds, on the other hand, are typically bought and sold at the end of the trading day. The flexibility that ETFs provide can be a double-edged sword, as it can be tempting for investors to buy and sell them frequently, leading to higher trading fees and potentially hurting long-term returns. What should you look for in an index fund? When looking for an index fund to invest in, there are 2 main factors to consider. The first is the track record of the index fund, including its historical returns and any fluctuations in performance over time. While past performance is not a guarantee of future results, it can be a helpful indicator of how the fund has performed in different market conditions. Take a look at this Vanguard index fund, which offers exposure to the consumer discretionary sector in the US. You can see that the fund is tracking the index almost perfectly. Another factor to consider is the expense ratio of the fund. This is the annual fee that the fund charges for managing your investments. It is generally a good idea to invest in index funds with low expense ratios, since these funds have lower costs and allow you to keep more of your returns. You can typically find the expense ratio on the broker's website, and in this case, this fund has an expense ratio of 0.1%. This means that if you invest $10,000 in this fund with an expense ratio of 0.1%, you would be charged $10 every year. So by choosing low-cost index funds, you can help to minimize your investment costs and keep more of your returns. This leads me to the topic of brokers. When you're looking to invest in index funds, you'll need to choose the right broker or investment platform to buy them from. It is highly recommended that you sign up for an investment account using the broker index fund that you're interested in buying. For example, if you want to buy Fidelity Index Fund, it's best to open an account with Fidelity and buy index funds directly from them. The same goes for other fund families such as Vanguard or BlackRock. On the other hand, ETFs are often available on popular platforms like Robinhood, Webull, or Wealthsimple and Questrade in Canada. These brokers let you buy and sell ETF shares just like you would individual stocks. Which index funds should you invest in? Just a friendly reminder that while I may know a lot about index funds, I'm not a certified financial advisor, so take what I say with a grain of salt, since every investor has a different risk tolerance and your financial situation may vary. However, the general consensus is that for younger investors with a longer investment horizon, it's generally recommended to focus on index funds that track broader market indexes like the S&P 500 or total stock market index. These indexes are more volatile in the short term, but have historically delivered higher long-term returns. As you approach retirement age or become more risk averse, it may be important to shift your focus towards index funds that track more conservative indexes, like bond indexes. These types of funds typically have lower returns, but are less volatile and provide more stable income streams. Here are a few examples of index funds that could be suitable for different age groups based on their investment goals and risk tolerance. For younger investors in their 20s to 40s, you can consider funds such as the Vanguard Total Stock Market Index Fund or the Schwab Total Stock Market Index Fund. In your 40s to 50s, you can consider investing in funds such as Vanguard Target Retirement 2045 Fund or the Fidelity Freedom 2045 Fund. And finally, if you're nearing retirement, you can invest in funds such as the Schwab Target 2025 Index Fund or the Fidelity Freedom 2025 Fund. All these funds are just examples and not personalized recommendations. As I mentioned, your individual investment goals, risk tolerance, and financial situation may vary, and it's always a good idea to consult with a financial advisor or do your own research before making any investment decisions. And that's a wrap. I hope you guys found this video informative and helpful in understanding how index funds work and how they could potentially benefit your investment portfolio. As always, thank you so much for following along. If you haven't already, I would love it if you would subscribe to the channel and hit the like button on this video. I'll see you next time.